Okay, welcome to this module of the Profile Trading Development Pathway. Make sure that before you go into this module that you review all the orientation materials and videos just to get you set and oriented to kind of the way that we see things and how these modules interface with each other. In this module, we're going to be talking about module 1, which is determining auction phase to set future expectations. And with all modules, we start with a challenge, and that is this, that traders love charts and they love to place graphical aids on them. Well, I should say traders love charts. Traders today love charts. Charts are still somewhat of a new phenomenon. Most pit traders didn't use charts, but electronic traders, as we are, use charts. And we use all types of indicators to attempt to make trading decisions. And the challenge comes in understanding why sometimes an indicator works flawlessly and other times it fails miserably. Well, the principle of the auction that we're going to lean on in this module is this, that auctions behave in predictably consistent phases. What does this mean? Well, that means that we can reduce potential future outcomes by recognizing which phase the auction is in. We can also use tools that enhance our understanding of which phase we are in and act accordingly. If a trader doesn't understand the behavioral phases of the auction, then he or she will struggle to understand why an indicator works in some environments and not in others. Like you could have a period of time where you just feel like you're killing it and you just like can't lose, and then you have a period where you feel like you can't win and you're scratching your head like what's broken. He or she will then continue to apply the indicator and be frustrated or abandon a working tool. It could be that the tool works, it's just in the wrong phase. And this leads to slipping into style drift, where you're going and looking for some new thing that's going to magically work. And it could have been that everything that you had did work. It's just recognizing what phase of the auction that you're in. All of that ultimately results in inconsistency and lack of confidence. And that is the antithesis of what we're trying to build. We're trying to build consistency, which builds confidence, and that leads to overall profit and sustaining in the market. Now, the outcome of this module is that we're going to help you arrange graphical information to help discern the current auction behavior or phase, which is going to assist you in better decision making in the current or pending auction phase, with a nod especially to this auction phase. Because if you understand what phase of the auction you're looking at, you'll know which tools will aid you. So, to start, take a look at your charts. So you may have your screen up next to me while you're watching this video, but ask yourself, why are your charts set up the way they are? Are they the default settings in your platform? If you've added indicators, which ones have you added and why? And specifically, how do those indicators support your decision making? And I've seen all kinds of charts. Like they look like this, and 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 they look like this. Right? They're all different types of indicators, but know that indicators perform better when we use them to help us see behavioral phases instead of relying on them as influencing the auction. What do I mean by influencing the auction? Like when a trader comes to me and says, well, we're in an RSI of this, or this moving average has crossed, or the MACD is this, so we're going to, right? Just because an indicator says something, it doesn't mean that the auction's going to, or we hit this Fibonacci number, or we're in this Bollinger. That doesn't mean we're going to. It's more it's displaying what's happening currently, which is hard because when you're trading at the hard right edge, you're trying to make decisions on what's happening next, what you believe is going to happen next. So you could be leaning on an indicator that actually has no predictive capability whatsoever. So that's why we're looking at the behavioral phases. And this is a key distinction for us, that fundamentalists interpret balance sheets, technicians interpret price, and profilers interpret behavior. So what we do is we isolate auction phases by reviewing recent auction behavior. And the way that we do that is we use two questions. The first is, which way is the auction trying to go? And the second is, how good of a job is it doing in getting there? Whenever I do the review for my plan every day, like the first thing that I do after market's closed, I look for the next session, I say, okay, which way is the market trying to go? And then how good of a job is it doing in getting there? And how I can help answer this question is that if I think that ultimately, if I stripped everything to essentials, I can describe all market behavior as either distributing, or in auction theory, we call that imbalanced, or developing, which we call balanced. And there are other synonyms as well. So if you think about distributing or developing, you might think of them as imbalanced or balanced, trending versus consolidating, or directional versus sideways action. Okay, so it's likely you know some part of this already. Just kind of want to bring you into the nomenclature that we use in auction theory. Now, the question for you right now, and then as we go through this module, as you're working through this module, is can you discern whether or not the auction in front of you is developing or distributing in a given time frame? So when I look at a chart like this, I'm trying to figure out in the time frame that I want to make a decision, is it distributing or is it developing? And when I look at a chart, it can somewhat, I can think that I see some of the trending or sideways action, but when we use profile tools, that helps us organize this information a lot better. In the day time frame, we use the market profile graphic, and this helps us clearly see when we have a lot of overlap from period to period, it's a balanced or developing session. When it's very elongated and there's not much overlap from period to period, it's an imbalanced or distributing profile. When I look at a longer term chart, and it's looking at that same chart, but I'm throwing a volume profile across it, I can start to see where some of the development and the distributions are. So for example, when I see an area where there's a high peak in the composite profile, that's an area of development. And then I can look and say, oh yeah, here's an area that I'm in development. When I see low volume areas, there was some distribution taking place across that, right? Here's a move. Wow, look, there's a distribution. So that we use those tools that can help us very quickly see, are we in a developing auction or a distributing auction? So again, the question then is, can you discern whether or not the auction in front of you is developing or distributing? And this is important because trade location is the best form of risk management. And how can you improve trade location to have a better application of risk? Well, poor trade location would be to take a trade looking for a trend when a market is distributing, or looking for development and the market is trending. So poor trade location would be to take a trade looking for the fade or mean reversion when a market is distributing, or looking for development and the market is trending, right? So if I'm looking for that's a fade back to the middle and I'm in a distributing trending environment, it's not going to work. And if I'm trying to find that breakout trade and yet I'm in a range bound developing market, that's not going to work either. So to help further refine that between those two questions, which direction is the auction attempting to go, how good is a job of it doing that? One of the ways that we know how good of a job is that we look at the 4 behaviors. And those 4 behaviors are a beginning, rest, test, and another move. Beginning, rest, test, and another move. Now here's what's great about these. They work in every time frame. So whether you're looking at a 5-minute chart, 30-minute chart, hourly chart, daily chart, weekly chart, monthly chart, it works. And it helps further define the 2 aspects of market behavior and helps us answer those 2 key questions of what direction is the auction attempting to go and how good of a job is it doing? And when you begin to see the relationship and correlation between these behaviors, your predictive capacities will drastically improve. Okay, so let's start with the first behavior, and that is a beginning, the first phase. This is the initial phase of auction behavior. And what happens is that something happens that makes buyers believe that the market is undervalued or sellers that it's overvalued, and the market moves up or down. The market begins and moves directionally until it brings in an opposite response. In other words, the beginning is a directional move or distribution. Described more precisely, the move is a distribution of capital. So if the capital flow is up, buyers are distributing because the market moves up to shut off buying. The capital flow is down, sellers are distributing because the market moves down to shut off selling. Essentially, the auction will continue in a direction until it finds someone who's like, hey, that's too much, and there's no more participants willing to go in that direction. So this is the distributing or trending behavior. Now, eventually, an opposing directional response stops the directional move and begins development for the next move. So when I look at a chart like this, and specifically, I look at the volume profile on the top of that, I can find areas where there was a beginning. So beginning starts from a high volume node. Those are beginnings. And sometimes they continue for quite some time until you can see up here how the profile diminishes and it gets high enough to shut off that buying, and then we start developing again. Same thing in this situation. We see where the volume profiles are to find out where those distributions are. Here's the new move. They'll get they'll get pullbacks, but eventually there's enough of a counter move to shut it off and define an extreme when it gets low enough that we find buyers. And sometimes those moves are a long time, and sometimes those moves are not very long. This is part of the reason why indicators that may say something's oversold or overbought just don't work, because it's not until the behavior changes that you really get the turn. So the beginning is it's a break from balance. So we've balanced, now we're going imbalanced. And so to find the beginning, we find an origination point that should be discernible. That's that peak in the profile. Beginnings often come with an order flow spike from balance. We'll talk more about that in Module 8. And it's also accompanied with tempo and volume. So basically you'll find an auction that seems really uncommitted, unconvicted, and then all of a sudden there's going to be some significant tempo and movement. The longer the balance, the longer and the wider that profile is, the greater the move. And then initially, price will be disconnected from value, and value has to catch up. We talk throughout the pathway about the relationship of price to value, specifically even within the anchor trades. But first price moves first, and then the value has to catch up. A balanced posture is a good indication of a pending beginning, and it continues so long as one time framing is present, and it ends when the counter trend activity is strong enough to shut off the directional auction. So when an auction, ways that we can use beginnings, when an auction is pending a beginning, we are looking for the breakout from balance. So we're balanced, we've got a large node in the volume profile, we're looking for a break from balance. And then once that break begins, we look to defend the side of origination. So we're expecting the price activity will be directional and strong. A good trade location is found going with the distributing move from balance. So when taking go with trades, we defend that originating balance reference. Now, after the beginning comes the next step, which is rest. And we're gonna go through these pretty quick, and then we're gonna look at some examples just so that you kind of know what these four behaviors are. So rest. So rest is when that counter market comes in. So we talked about how the market will move up or down until it brings up sellers or buyers that shut it off. Once it's shut off, then the auction starts rotating around a point of control, a price that the auction is trying to establish as new value. And when both buyers and sellers are present, the market comes into balance and starts rotating. This is the second step, which is balance. And it's the market's response to that initial up or down move. And it comes into balance because market participants are too uncertain to continue going in one direction. So what ends up happening is we have to spend time, taking a breath to see if we want to continue that, or do we want to go back in the other direction. So price when you're in the rest phase, price reverts to nearby value reference. So you're getting more mean reverting and price reverting action than directional trending. And then what happens is that on the day time frame in a market profile, value begins to overlap from day to day, and then rest is seen with a distribution complete and a bell curve is present. Bell curve just like a statistical distribution. So like this, if I flip that on its head, we'll know that we're in a balancing behavior. So like when I look at this chart, I can see that as the market started, what started directionally, which finds counter activity that starts the price reverting, it goes lower, then it goes higher, but we're all within this range, back and forth, back and forth, back and forth, until we've got a very prominent node. Same thing happens here, moves higher till it shuts off, finds a range of price. And sometimes those ranges can be super wide, sometimes they're super narrow, but eventually it gets tighter and tighter and tighter until there's a very defined area when you're in this behavior, you're basically looking to trade the edges, right? When I'm in a distributing or beginning, I'm looking to go with. I'm looking for any pullback to go with. When I'm in that sideways action, I'm looking to fade the edges, right? Same thing here. Now, there's ways that we can predict rest is going to happen. One, we'll start to see some divergences, and this could be divergences between price and value, where the price is getting too far ahead. It could be that the auction is establishing excess, meaning that in a short time frame we see some counter activity that steps in that's rather strong, and that the auction direction and quality degrades. Maybe from a session to session, we're getting less and less volume, less and less participation. So ways that we use rest is that when the auction has established this range that becomes the playground until it isn't, the best trade location is found at the extremes of the range and trading back toward the most traded prices. And this is a challenge for a lot of traders to go from, going with the trade in a beginning mode to in the rest mode, and now I'm back and forth. But in these environments, we are most active at the edges, and we watch how we behave when we approach the edge of that balance range. Because if the edge fails, we're moving to the next behavior, and that is a test. So again, there's two overarching behaviors: distributing, developing, right? Trending, consolidating. Well, sometimes we get what looks like a new trend that fails, and this is a test. So this is the third behavior. So it occurs in the balance area. So it's as the market is trading sideways, and it's going to look like a new test. So how long a market tests, of course, depends on the news and market developments, how willing market participants are, but at some point, buyers or sellers are convinced that the market needs to move, and they're going to test new territory. So they're going to break out of a balancing range, and they're going to test it. Now, I will tell you, it's one of the harder trade behaviors to discern, because it's really easy to look back and, oh, that was a trending market, or that was a balancing market. But a test is a little bit harder, because first, it's just a new move. It's a breakout away from balance. However, the move fails to attract additional participants and returns to the prior balance zone. So let me give you an example here. In this balancing range, so you can see that the auction moved up, traded lower, moved up, traded lower, has some, and then actually had a node that it looks like it's making a new move here. And then it comes back in the range. That is a test. Similar to this one right here. It looks like it's making the next move higher, and then it fails. That's a test. This looks like it's breaking out lower, but comes back. That's a test. It's testing the range. It's where it looks like it's a new break, and it typically starts from a balanced node, but then it rejects back to that scene. And unfortunately, that's how we know it's a test, is it comes back fairly quickly to that. Until that happens, we just see it as another move. It's a little bit easier to see on a market profile graphic, where you can see several sessions like this of balance, right? And then we try to get outside and come back. So this attempt away, and we think that that's a new move away, but when it comes back inside, back to those prior sessions, then we know, hey, that's a test, and we deal with it accordingly. Similarly, as seen here, where we have multiple days of overlap. We have multiple days of overlap. And then like we have a session that opens lower. So that could be a new move lower, right? Away from balance, but what does it do? In 3 sessions, it comes back, and that negates the move. So using a test, when we talk about using a test or thinking about when you're in that behavior, you define and monitor range boundaries. So you know where the balance range boundaries are. Then you're going to watch for activity approaching the boundary. So one of the biggest clues is tempo. If we're coming toward a boundary just kind of meandering, likely that boundary is going to hold. But if we come at it fast, then it's likely to break. But if the attempt is rejected, there's opportunity to aggressively join the counter auction. And what do I mean by that? So like if I go back and look at this activity here, so when the auction attempts lower like this, and that's a test and comes back, then there's typically a high probability trade to go this way. And it doesn't mean that that's a trade that we take, it just means that that's what we anticipate the auction to do, because you got confidence that the auction couldn't go in this direction. So now you're giving participants confidence to go the other direction. Now, when it makes an attempt that looks like a test, but it actually holds, that's another move. So this is where, you know, we're still at a rest, and then the auction breaks from balance and gains acceptance. And the prior balancing range is left behind for new territory or a prior high volume area of acceptance. And that's the fourth step, is another directional move. So here, when we actually make this move, it, you know, looks like they're going to come back, but they keep going and establish value elsewhere from this new. That's another move. So it was at rest, it breaks and holds, that's another move. At rest, breaks and holds, that's another move as well. So definitely keep an eye on these higher volume areas and watch the activity. If it moves with tempo and stays away from that side of origination, that's another move. If it comes and goes back quickly, then that's a test, and you could look for the counter activity. Like in this case, here's an attempt, looks like an attempt away, comes right back, and then notice what the behavior does after that. It goes in the direction. Now, you know, how do we know that we're gonna have another move? It's similar to how we know a test is coming, is that we're balanced. And we're gonna look for order flow spikes just like we would with a test, but the difference here is that the move is accepted, meaning they're gonna continue to find participants willing to go in that direction. And this is another attempted opportunity to go with the auction. You know, at first the trade location is going to appear poor, but we'll use that prior balance range as a predictor of further excursion, so that can help us set risk. Meaning, if I go look at an area like this, and I say, okay, this balance area here is about 30 points. If I make a move from 137, that should get me to 100. That's how that works. So if on this sense, I've got a range 134 to 111, I'm getting a move. Similarly, that's a way that we can predict that if it's another directional move. Now, let's put them all together and then look at some more examples. So over time, this four-step behavior pattern forms what we call a distribution in the auction. It's not terribly important that you understand that, but each phase of the pattern is part of a larger whole. And this is key to using profile data effectively, because you can relate the parts to the whole, the day time frame versus the long-term time frame. Meaning, you can see the distinction between the market using the long-term volume profile and individual marketplaces or day sessions using the market profile. Again, the market moves and begins directionally until it brings in an opposite response. The opposite response stops the directional move and begins developing to build value. This is the rest phase. Then we trade back and forth around that area, developing value until we get above the high or the low. If you look at the market at any time, you'll see these three related areas, a high, low, and value. And then when that value is in the middle, between the high and the low, distribution is complete. So let me draw that for you, right? So here's an auction. Whoop. Here's an auction that moves. Then it's going to get counter activity, and then it's going to, you know, start rotating back and forth. While that's happening, it's developing value, or most traded price, and it's going to keep trading back and forth across this, across this, across this. And then there's going to be either a test, which would test these highs or lows and then fail, or another directional move, which is going to go and find additional acceptance. So in all of that, the question that you're going to ask yourself is, well, what phase am I in? Am I in the beginning? Am I in the rest phase? Am I in a test? Is this a new move? And then if, whatever phase I'm in, what phase is coming next? Because this is awesome. I know that if I'm in the beginning, I know rest is coming. And then if I know that I'm in rest, there's a new directional move coming or a test. And then what information from the auction would confirm or negate the expected coming phase? And how can I then express a setup inside of that expected phase? So, one way to do that is just to take a longer term chart like this and just try to isolate the different things. And these are daily profiles over time. And I can see an area of rest. Let me get I can see an area of rest. Then I've got another move, rest, tried to make a new high, came back to the middle, that's a test. That's from day to day. Then if I look intraday, that's what's so cool, is this can even happen intraday, right? Here's an early opening swing. These are 5-minute bars. Counter the activity, shuts it off, sets a range. Then there's a move, counter activity shuts it off, sets a range. Then there's a new move, counter activity shuts it off, there's a range. Attempts higher, that's a test, back to the middle. Attempts higher again, that's a test, that's attempts higher again. Maybe that's a new, opportunity. If it is, they're gonna keep going or they'll rotate back in. But that all happens within the one day. And over time, what you get good at is discerning which one I'm in, because again, that helps you predict what comes next. Like this, what comes next? I had a prior area of rest, then I had a move, then I had a counter activity that's not, that shuts that off. Now I've got a range. So I'm watching, and I know a move's going to come from this high volume node here, and either it comes up here and rejects back, or if it moves higher, where's it going to go? Back to the high volume area from back up here, or from here it could go test the lows and revert, or break out. Now, when it comes to applying our IB trades to this, whether it's our extension fade or IB go with, remember our questions are, should I go with it or should I fade it? In any auction, should I go with it or should I fade it? Well, if the auction in front of you in a shorter time frame, intraday time frame, is in the beginning phase, I'm going to look to go with that. Or I'm going to wait for counter move to establish development. So if I want to fade it, I'm going to wait for the counter move. If I want to go with it, I'm looking for any pullback that I can get to go with that and stay with that until I see strong counter activity. And if I'm in the rest phase, then I'm looking to play the edges. And which is easier than playing from the middle. I can play from the middle out to the edges, or I can play from the out into the middle. It's easier from the out to the end. But macro, either there's a test or a new move coming, and that may not happen until the next session. And then if the auction in front of you is in the test phase, you're watching for acceptance of that new move, because you're like, well, it could be a new move that I could go with. Can they hold? And if it returns back, then I know that that's a test. So if I return to those old ranges, then I know that that's something that I can fade and defend the failure. And then if it's a new move, then I'm watching for that acceptance. We're going to get it and I can go with it. I'm going to defend the scene of the break. If I return to old ranges, then it's not a move, but a test, and you can fade. And you can have more confidence in a break if there has already been a test of the other balance zone extreme that failed. What does that mean? That means if I have a range and I've already broken this way, I can have more confidence in the directional move this way, because there was already a test that failed in that direction. Now, just going and looking at activity from today, if I expand the profile here, I've got a little bit of both going on. These are 30-minute periods. But what I had earlier is I had a little bit of development, then some distribution, and then some development. So early on, there was development, then the distribution, you would want to go with that, and then development. In this case, there was no IB extension, so all of that happened, and there was no trade to express around that. However, in a prior day, notice that this had already balanced the prior day, attempts higher, that's a test out of a balancing range, rejects back to the middle, and then look and see what happens after that when they come and test the other side and gain acceptance outside of that. That's a new move. So here's a test. Here's rest, test, new move. So now we've got a little bit of rest going on. So we're going to look to see how long will we rest, and then if we go this way, did we get acceptance or did we come back to this node? If so, that's a test, and then we would look for the opportunity this way. Now, this leads us all back to this idea of indicators. Like what indicators do we have on our charts? And when making trading decisions, the trader wants to be looking at indicators that the most auction participants, or at least the deepest pockets, are looking at. And those indicators are real simple: price and volume. Think about it. It doesn't matter if you're a hedge fund, it doesn't matter if you're SoftBank, Goldman Sachs, Deutsche Bank, you're some CTA, you're Joe Blow retail. Every trader that's trading the ES sees the price and they can see how much volume is traded, right? Outside of that, people could be looking at different things to make decisions. So, for example, indicators like an RSI, ADX, MACD, they can be helpful to help discern and learn price action or isolate phases of the auction. They can be effective if I'm using them to help me figure out what phase of the auction that I'm in. If I've got an RSI or an ADX, for example, that are pushing high numbers, that's an indication of directional strength. So until I see that start to diverge, I wouldn't even think that that's about to change. And be careful not to rely on any indicator as a guarantee of what other auction participants are going to do, because it's just simply not the case. Everyone would have to look at the exact same thing that you were for that to hold true. So your fib number, or your RSI number, or your Bollinger Band, or your 2 standard deviations of VWAP, or whatever it is that you have on your chart that you believe, well, we can't get past there. Guys, I'm telling you, we can. We can. I've seen it. There'll be phases when you're just like, you won't believe it. But like, for one, 2 standard deviations of monthly VWAP. We spent time here in 2020 where we spent an entire month outside of 2 standard deviations of the monthly VWAP. That shouldn't happen, and it does. But overall, as a rule of thumb, if you can't describe why an indicator is on your chart or how you've used that indicator to help make a trading decision, then do yourself a favor and remove it. Only add things that are helping you make decisions, that are helping you organize the information and know what phase that you're in. And when you can, favor indicators that are price leading, not lagging. Pick indicators that help visually see exceptional behavior. Choosing indicators that other auction participants are using. So algo funds, institutional desks, for example, like an 8, if you want to use moving averages, 8 EMA, 21 EMA, 200 SMA, VWAP, momentum, order flow, internals. Those are things that larger players in our space pay attention to. I'd encourage you to have as indicators on your charts if you'd like. But at the end of the day, use whatever indicators you believe help you see the auction phase better. And at the same time, remember, there's no such thing as overbought or oversold. There's distribution until there's development, and there's development until there's distribution. Okay. Now, let's look at a couple more examples before we land the plane. And this is part of the homework, is just getting you used to identifying these behaviors is to just to take a chart and pick different time frames and see if you can find where beginnings, rest, test, and so forth are. So like here's a daily bar. I can see a really strong area of development here that took place for some time, and then I can see a break from that area, okay? And while I get pullbacks, I don't get any lower lows. It's not until here that I get a lower low, and that's defining a range. So here was the development, or the distribution, here's the development, and then guess what? There's a new move, and it holds outside of that range and just keeps going. And then it makes a lower low. Now I'm in a new range, pushes out, comes back, tests the top of that range, makes another move. So it doesn't, we don't have to have a test. We can actually just have move, rest, move, rest. But then notice as this market's continuing to over time distribute, that the participation in the profile is getting less and less and less. And so that's why, like way up here, when it starts to come back this direction, one of the things that can lead to that counter activity is a lack of directional participants at those higher prices. Okay, another way to look at it is look at a market profile graphic from day to day. And a good way to know whether you're distributing is your one time framing. Every day is making value one time frame higher than the next. And we may come back for a day, but then continue. Okay, that's a distributing auction that started from multi-session overlap. When you're seeing lots of overlap from day to day, then you're in the developing phase. So when does it stop distributing? When it starts developing. Here, this is looking at multiple volume profiles overlaid just to try to see the relationship to them. Here's a monthly profile with weekly profiles inside of it. Here's a move. Okay, weekly basis, one time frame on the weekly basis. Now it's getting thin up here, so I'm looking for and expecting some type of counter activity to shut this off. But until I see that, any price higher is possible. Okay, in this one, here's the beginning. Auction moves higher until it can make a lower low, sets a range, and then look, it makes a new move. Where's it coming back to? A prior area value. Let's look at a shorter time frame. Here's intraday. So here I've got balance overnight and some balance from the prior day. So I've got a node on the volume profile composite, and here's the beginning. Look at this on a 5-minute basis. Go, 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 go. Right? And there's just a little bit of what looks like rest, and then keeps going. So if it came back in here, that would shut that off, and I would see that as a test, and then I could see the auction going this way, and then maybe break and come back through some of the stuff. But that should buy you time. And one of the challenges that traders do is they see a big move like this, and they think, oh, it's moved so far, I should just take a counter trade, and then they get run over. This will help you not get run over. By spending time just looking at different charts. This is volume bars, volume candles. Here's a beginning. Look at the move. There's a counter activity here, but it would be, and if we were able to go like that we would be establishing the range. So this is just a pullback that keeps the move going. Here's those several sessions of overlap. Now we're moving out of there, one time frame. Now this day, the auction opens above and comes back inside. That is counter activity. And then I'm now setting and looking for, at least for up here to start at the range. I don't know where the bottom is. It could be back down here, but at least I know where the top is. Here's several sessions of development, then distribution, and then counter activity. Now I'm in development. Moves, counter activity, got a range, looks like a test. If it comes back to there, it was a test. If they keep going, it's a new move. Okay, here we have 5 minutes where they're just, this is just resting behavior. Round to middle, building out a node in the profile. Again, just illustrating how this all happens in all different ways depending on how you're looking at the profile. And then what you include. Here was a bottom of a range. Here it looks like the auction is trending for a couple days, but then ultimately comes back. So this is ultimately the large range. See, there's a big node here. The auction, while it shut off this 3-day move, it's really just reverting back to the middle of the range. So now could it go up here and then look for it to test until it can get above these highs or below these lows? That's the playground. Same thing here. You can see how it's just back and forth, range bound, balancing trade. Range bound, makes an attempt lower, comes back inside. So, we're got a range, pushes higher, pulls back, got a range. So now I've defined the range. Here's an attempt over that. Maybe that's a new move. Nope, they come back. Then it comes back to the middle. And seen in the the composite for the day, very rotational, very bell curvy, just like a developing auction. Here I had a move, engulfing, shuts it off, establishes a range. Then here's a new push. They hold outside of it, but then the seller comes back and shuts that off back into that range. Now we're back to the middle. Here we have several sessions of balance. First attempt away, next session comes back. And then they make another attempt. And in this case, the auction attempted higher and then closed lower. This case, it opens and closes higher. This one is a test. This one is another move. And so I would defend below that price and look for the auction to keep going as part of my plan until I saw counter activity. Here's bracket zone. Here's another way that we can see and anticipate. Lots of balance, big node in the middle, push, and this one actually has, we'll talk more about this in other modules, big deltas, impulsive activity, single prints in the profile, big volume. That is the type of tempo that we mean that will help us get into new territory. And so we would defend the high here and look for the auction to keep going. And at least go, if this is 2 handles, we'd look at least for it to go 140 down to 138, 2 handles. All right. This is one that typically gets traders caught up because they see like these single prints in here. This is all impulsive activity. That's strong directional. So here's what it looks like on a 5-minute inside of 30 minutes, and here's 30-minute candles. But auction was balanced, and so far it's a new move. And this is the one time framing that we're talking about. One time frame, higher high, higher low on a 30-minute basis, and even on a 5-minute basis. Till that stops, any price higher is possible. You can look at all these charts like this, pull up any chart that you have. And again, I've got indicators down here. They don't mean anything if the behavior doesn't support it, right? So here I've got a bouncing auction, like it's touching VWAP. And this is actually one of the things that helps me know if I'm in a bouncing or distributing thing is what's VWAP doing. If the VWAP is sideways, likely to just distribute or developing. If the VWAP has a slope to it, more likely distributing. So that's a way that the indicator can help me figure out which way it's at. So, land of the plane, if you can observe the phase of the auction you are in, as you review it, you can anticipate the next one to come and be prepared to act. And that's your plan. Now, homework for this phase, if you want to keep refining this, is to select a product for a coming session or to go back and look at a historical chart, just like what we did through all those examples, and use a time frame that you use to make decisions, whether that's a 5-minute, 30-minute, whatever, and mark those 4 behaviors and build the narrative for what you believe will happen next. And maybe even cover up part of the chart as you kind of move across, like print them out, cover it up, and kind of move it across and see how predictive you can get. Also focus on the behaviors that are easiest for you to identify. So if you can see the trends, just mark out all the trends. And if you can see the areas of development, mark the areas of development, and then that will isolate to be able to see the other one, and then practice the IB trades within that. If I'm looking for the fade, I need to find, if I'm practicing the fade, I need to make sure that I'm starting to develop. If I'm looking for the go with, I want to find a distributing trending market, even if it's in just a short time frame. And then share those and get some feedback. But that's module 1, guys, determining auction phase to set future expectations. Hope that helps you make better trading decisions as you develop your plan and express that on the market day in and day out. Peace.